Hi. This week's module is actually covers chapters 9 and 10. It's unfortunate that it covers both of them. They're both pretty complex concepts. Chapter 9 talks about the discounted cash flow, present value and future value. Um, so you're gonna learn how to crunch the numbers. Chapter 10 then is the application of chapter 9. So chapter 9 is gonna kind of talk about the concepts of present value and future value, and it's going to enable you to establish a present value, for example, of future cash flows. So if you remember, in the past we did a little bit of forecasting, right? We talked about, okay, in these next couple of years, how much cash we're going to have, and now at the end of this chapter, we want to be able to calculate the present value. All right, the present value of those future cash flows. Okay, so there's three ways to do these. I'm just focusing on the present value. Actually, both present value and future value, but the present value is going to probably be more important for your final project because that's what you're going to be doing when you value your company. Your company that you pick is going to have 5 years of what's called free cash flow, right? You're going to have to come up with some guesswork. What are those 5 years of free cash flow going to be? And you are going to come up with the present value of, so you're going to do 5 calculations: present value of year one, present value of year two, present value 3, 4, and 5. You're going to add those up. And that's going to give you one part of your answer. So, three ways to do this present value calculation and future value for that matter. One of them is to use the tables. So there are these tables. You have to pick the right table that says present value of a single dollar, for example. So you're going to line up, you get the table, and you line up what is the interest rate and what is time, or T. You're going to get a factor, 0.574. Then you multiply the free cash flow, for example, times that, and that'll give you your present value. So the tables are one of the ways you can calculate individual single present values, okay? The second way is to use Excel. If you go to the top of Excel, there's what's called FX. It's like kind of the top middle, and there's a little FX. If you click FX, whole menu of all different kinds of things that you can do come up. You type in present value or future value, and then this wizard will come up, and then you'll pop in your time, what your future value is going to be, and then what the interest rate is going to be, and it'll spit out your answer. So that's the second way. I've sent you 2 videos of how to use your Texas Instrument calculator or your Hewlett Packard one. So you could follow those through, and to learn the manual of each one of those walks you through as well. But essentially, you're popping in on the calculator what you know. So in one case, if you're solving for present value, you're solving for PV, then you punch in the other 3 things you know. You're always trying to have 3 pieces of information. So if I'm trying to solve for present value, that means I already know future value. So I'll put that in. I already know the time. It could be a year, it could be, so that's N, number of time periods, and then interest rate. Right? What's the interest rate you've been given? And then at the end, for at least for the HP, you press PV and it will spit out your answer. That's the calculator way. So using the table, using Excel, using the calculator. I would ideally, so you can learn how to do this, I would do 2 of the 3. So if you're not sure if you did it right or not, do 2 of them and see if you can come up with the same answer. You'll know it's right. Okay. So that's challenging. Chapter 9 is a challenging concept, but again, we know conceptually that a dollar today is going to be worth than a dollar tomorrow. The main reason is inflation that we talk about, but another reason is risk. Right now, if I get someone says I'll give you $1 now, or I'll give you $1.10 tomorrow, I might take the dollar now because I know what I can do with $1 right now and what it's worth. Down the road, meaning 1 year from now, I don't know what $1.10 will be worth, right? So again, that there's a risk. I say what it's worth because of my situation. If I'm in a business or my personal financial situation, maybe I want the money now. Maybe then I can turn around and invest it. So those are the two reasons um, why a dollar, or something in the hand. Now, future value is a little bit simpler. One thing to remember is if you draw a timeline, I'm a fan of timelines. If when you're doing future value, you know what you have right now, and the question mark is, what am I going to have next year, the year after that, year after that? So the question mark is the end of the timeline. I know what I have now. What am I going to have later? Present value is I know what my future value is going to be. I'm gonna get $10,000 in a year. What's that 10,000 worth right now? So using my three variables, my future value is $10,000. I would plug that in. I would know how long it's going to be. I'd put in an N, and then I'd get the rate that is given, and you punch that in, and then you solve for present value. Okay, so that same thing would happen in the Excel when you do it in Excel. So chapter 10 then applies pretty much present value. Chapter 10 makes the assumption that we're going to use present value. So they talk about stocks and bonds, okay? And they talk about how you need to know how stocks and bonds work. So that complicates it a little bit. So a bond in both cases, there's typically two things we need to calculate. For a bond, the cash flows that we're looking for, or sometimes we have to calculate it, but if we have a bond, we're gonna get interest. We're gonna receive interest. That's called an annuity. So we need to solve for the present value of annuity. If I have a bond, I'm gonna get $100 interest for 10 years. So I need to calculate that part. Then at the end of the time, I'm also going to get what's called the principal, because bonds only live a certain time. So with a bond, I need to come up with two present values. One present value of the annuity, which is a series of equal payments, and the second one is what's the present value of the principal. I add them up, and then that's my price of the bond. So that's how they value bonds. That's a financial instrument. So essentially, that's what they do. With bonds, if they don't give you what the dollar cash flow is, you might have to calculate it. It's a $10,000 bond and it pays 10%. All right, so that means $100. Like 10, right? And multiply 10,000 times 10%. That's going to be what they call coupon. And that's going to be my interest. I'm going to get that amount over and over and over again. So that's what I crunch. So that's bonds. And by the way, I've included a couple voice threads that might help you with this. Second is stocks. And stocks are a little different because they're infinite. They go forever. They could go forever. So with stocks, we can get cash flows from dividends. A lot of the examples in the book assume a dividend. And the other one is something called capital gains. And what that means is, if I'm going to invest in a stock, I'm going to invest here, and I hope the stock's going to get more, right? So that's called a capital gain. So when I calculate the value of a stock, one of the ways is to do a discounted cash flow. So that means I'm going to come up with the value of the dividends, and this is going to be different. It's not an annuity. So typically, the dividends may be a different amount. Let's say I'm going to get dividends for 5 years. Those 5 years, I need to calculate an individual present value for each one of those. Add them up. Then I'm going to say, well, I think I'm going to sell the stock for $30 at the end of 5 years. So that again is going to be a present value. How much is $30 going going to be worth right now? How much is $30 going to be worth right now? So I calculate that and then I add them in both together. So that's one way to use discounted cash flow for a stock. There's another thing that we should have covered before. It's called PE ratio. And that's another way to come up with a value for a stock. You come up with the earnings and then per share, and then you come up with the price per share. And then you do a comparison. All right? I mean, you compare against I'm looking at, I want to buy Home Depot. So I look at maybe their big rival Lowe's, and I see what the PE is of Lowe's, and maybe I apply it. So there's a little bit of math. Again, PE is price per share, and divided by earnings per share. That's called the multiple. Like ratios, that one thing won't help me. I need a comparison. This PE versus what? All right. So with math, if I write on a piece of paper the P divided by the E, if I have two of the three components, I can come up with the price, or I can come up with the P, or I can come up with the P or the E or the multiple. All right, so it's a little bit of algebra, but play around with that. And again, I would look at some of the links online on how to use PE for valuation. Let's see. Good posts. Good posts. I like what I'm seeing. Again, push yourself. Look up. I'm seeing some good links to other resources. But if you have a question about the material, and particularly in your second post, not necessarily the first post, throw the question out there. Maybe one of your colleagues can answer the question, right? Or maybe you can help each other via that, as long as it pertains to the question at hand. Okay. So again, a lot of work this week. A lot of work. Really important grounds to cover, particularly the present value, because that's really one of the major parts of finance that helps us in valuation, helps us in capital budgeting, where we might considering investing in something going forward, and then we expect to get some cash flows from it. So that's another way. Again, a lot of work. So I definitely encourage you to use Excel. That is sort of the methodology that is used in finance a lot, and it's once you get familiar with how to do it, you're plugging and playing it. You're putting the numbers on Excel, then going into the FX, then you can just click into the cells to populate your stuff. So sorry for the late post this week for me for the video. We're almost done. 2 more weeks, right? And I'm gonna be doing in 10 minutes tonight. I'm gonna be doing the we're gonna be doing the a Zoom call, and I'm always open to doing Zoom calls if any of you are stuck, and I can help you go through the stuff. All right, so just let me know. So keep up the hard work, and hopefully I'll see a bunch of you